Good evening, everybody. I do credit spreads tonight, which has a little bit different math to it. So I hope everybody's got their coffee and hot chocolate. We'll go ahead and pina colada. There you go. Okay, credit spread is a different way of looking at things. And a lot of people don't pay attention to credit spreads because they're usually slower and more boring. But they're also a very good strategy for somebody that doesn't have or can't sit at the screen all day long, wants to put on a trade and kind of let it move in their direction. So they're extremely profitable, meaning not percentage-wise, but no, that's the right way to say it. Not dollar-wise, but percentage-wise, they're extremely a high probability trade. And it's got a much lower risk to it. So when we're using candlestick analysis, we've got the advantage of the direction of a move, and that's all we really need is the direction of the move. The timeliness, not necessarily the magnitude of the move, we just need to know the direction. And when a credit spread is favorable, when a call or a call spread is too expensive, and when the target doesn't make the bull trades feasible, there might not be enough room left in the market trend, and that's the third one. Market is getting a little bit iffy. So what we want to look at is if we can identify what the direction is based upon our normal pattern analysis. Then we want to go take a look and say, all right, let's do a call spread. If we did this call spread for $10, it's $5.05. That's, to me, that's too expensive. Don't want to have anything over $4. This one's $4.20. That might be getting you into the maybe range. And this one is $3. So that works. But what is the risk of that trade? So a bullish spread at $3.80, the price has to go above 175, I forgot where it is. Right now it's at 160. Price has to go above 175 for that price to go from $3.80 up to $10, or $6.20 to give you 163% profit. Excuse me. Just buying the calls outright, the 165s at $14 would be the price. To make the same percentage profit, it would have to go to 188 versus 175. So that's a pretty hefty move. The break even now becomes on this fully spread 168.80 on the spread versus 179 buying the calls outright. So the price would have to move to make a call spread profit. Still have to move up above this level right here to make that profit. Would have to move up here to make that same profit buying the calls outright. However, a call spread versus the selling a put spread. Now remember, selling. Whoops, sound is off. All right, there you go. Sorry. Selling a put spread is a bullish trade. It's not buying a put spread. It's selling a put spread. Now, am I too loud? Is that what's happened? So if we sold a put spread, the 157.50, and bought the 150 put spread for $2.45, now the break even with the stock trading at 160 is down to 155, meaning the opposite direction. Or if we went up a little bit higher, a little bit more risky, right there at the price that is trading right now at 160 and 150. So we sold the 160s, put that money in our pocket, bought back the 150s. That's our protection for $3.45. Now our break even is at 165.60, 156.60. Now what that means is instead of the price having to go up here to break or to make your profit, the price just has to stay above here. Meaning if we think it's going in this way, all they have to do is stay above these levels for you to make a profit. Which I guess that was an illustration that it did move back. But why do most investors lose money in their trading options? First of all, they have the problem of even identifying the direction of a move, let alone the timeliness and the magnitude. So selling spreads, meaning credit spreads, takes advantage of that process. That the premium that is built into the prices, with it going this way, if you're selling the puts, that means they have to come back. Let me see if I did that. Oh, we did the same example here. That if we bought a bullish spread, the 60-65s, because we thought the target could be up here to the 66 level, the 200-day moving average. So if we sold or we bought the 60s and sold the 65s, it would be $2.25. So you go up to the $5 level to make $2.75. But if we sold the 55s and bought the 50s, now we put $1.20 in our pocket. Now that's not as much as the $2.75, but to make that $2.75, price has to go up here to make money or put that money in your pocket. Price just has to stay above this level. So that's essentially putting that premium in your pocket. Let's see. Oh, so depends on how much risk you want to take. If you bought or sold the 60s and bought the 50s, put $2.85 in your pocket, which still means that to make a profit buying the call spreads, it has to get up to this level to break even and this level to make $2.85. Whereas if it stays above this level, you made that, what do we say it was, $2.85, and it didn't even have to move in this direction. All it had to do was stay in here, not even move, and just stay above this level. So is that clear? Now, the risk factor is, why are you buying or selling the 160s, or what do we say, selling the 60s and buying the 50s? Because if something drastic happened and they just crunched this, you had sold the 60s to somebody, that means you're going to have to buy it back. You sold the 60 puts. So let's say you sold the 60 puts and bought the 50s. Well, what's your maximum loss at this point? What determines the spread distance? Your risk reward. That's what we're getting to. Is if we bought the or sold the 60s and bought the 55s, what was it? You put $1.20 in your pocket. That would mean that the break even on that would be somewhere around in here. So what was your risk reward? You put $1.20 in your pocket. Let's say for some reason they slammed it. Well, your maximum loss would have been the difference between the 60 and the 55. Hold on, WB, let me finish this before I. So your maximum loss would be $5, but you've already put $1.20 in your pocket, so your maximum loss was $3.80. So that buying the 50 or buying the 55 is your maximum loss was $5 or $5 minus the $1.20 or $3.80. That's the protection. Now, remember what the strategy is of selling a credit spread. That it's a lower risk, you're not making nearly as much money, but based upon candlestick analysis, if we figure over the next whatever time frame, I should have also put on here, but if I'm doing a credit spread, I don't want it to last very long, because obviously the less time, the less movement you can have of a big reversal. Now I forgot what it, so I usually do a credit spread less than 5 days out, meaning if it looks like things are going up and it's a Friday before the next Friday expiration, that's about the maximum length I want to put on a credit spread. Yeah, about maximum of 5 trading days. I'm more likely to put the credit spread on a Monday or a Tuesday, which we can do when we go to some live charts here. Now I forgot what I was saying. Oh, for a Monday or Tuesday, because I don't want to have a whole lot of time where you could have a big downdraft. Now, again, the worst case scenario is they open it up and do a big reversal and it looks iffy. You could always buy back that spread. Now, remember, the closer you get to expiration date, which might be right here, even if it backs off a little bit, that spread will still probably hold up because the premiums are disappearing between the two of them. So what? Okay, so yeah, back to the spread distance. If I'm pretty confident that we're heading in this direction, and that would also be a function of seeing the market is turning positive or everything's positive, yeah, now I might say I want to take the, what I'd say, 60 and sell the 60 and buy the 50. That's 10 points. But now instead of putting $1.20 in my pocket, I'm putting $2.85 in my pocket. So what's my maximum loss? Well, if all of a sudden they announce that they're something big where it crunches it, my maximum loss is going to be $10 minus the $285 I already put in my pocket. So that's $7.15 that I lost. Now, why do I want to have that protection? Because every time we put on a credit spread, it's not going to be a big profit, meaning big money. If we did that 285 and it works, and then next week we put on one that makes you 75 cents and it works, they're not big profits, but they're consistent because you've got the advantage of seeing which direction the price is going. You're at a very short time frame, so you're anticipating that price move is going to move and then continue to move in that direction without a big reversal to come back below your break-even point. So what you don't want to do is say, all right, I'm going to get a little bit more greedy. Instead of selling the 60 and buying the 50 for protection, maybe instead of putting $285 in my pocket, I'm now putting $3.25 in my pocket. Well, that seems all right, except for the fact that the next day they come out and announce that they're going to miss their earnings, and it comes all the way down here. So now the $3.85 that I put in my pocket, I've got to buy it back, those puts that I sold back for $32. Well, that's a hellacious loss. It's going to take a heck of a long time of doing 70 cents, $1.10, $2.85 to get back that $32 that I just took the risk of, or wanted to be more greedy and not protect my my downside. All right, so I'm going to still try to illustrate that if we think this is going up, now this could also have some ramifications that maybe the market itself is starting to get a little bit toppy, but we still think this one's going to move, but not to this magnitude, maybe just up in here somewhere, that we do the credit spread, knowing that it will probably move in this direction. It won't come back through this direction. So that debit spread versus a bullish credit spread, basically selling a put spread, just alleviates or mitigates the risk. So if we thought Apple bouncing off the 50 was heading higher for a target of 300, if we did a bull spread with it trading at 480, I don't know what I did here. Oh, how far out do we go? Well, if we're buying the 280, 290 for 483, that's too expensive. 285, 295 for $4, that's just on the fringe. 290 to 300 for 333, that's okay. But now what's our risk factor? That the price of that stock definitely has to go to the 300 to make a 200% profit. Let's see. Where at the same time, if we sold the 280 and bought the 270, and we put $3.55 in our pocket, and the stock, I forget what did we say the stock was trading at, 280? As long as the stock stayed up 276.45, because that would have been the 280 minus 355, that was our break even, which meant instead of having to go up in this direction, which we thought it was moving, the price would have to close back below this level to take away what do we just say, 385 that we put in our pocket. Now, if this was a 5-day trading period, that might be pretty difficult for the bullish move to be that great. But the bullish move could be anywhere in here for the next 3 to 5 days, as long as it stays up above that, let's just say 276.55. We're going to make or put that money in our pocket. Now, let me see if I've got it in here. Oops. All spread. E33 had to go to $10, like $6.67. Apple had to move 20 points higher to make that 6.67. But the call spread that we put the 385 the 385 in our pocket, the price just had to stay above the 280. It didn't have to move. So now you can start calculating that if the move is likely to go positive with a high degree of probability, see what I did here. Oh, to put that 355 in your pocket, again, to maximize your profit on the call spread, it would have to go up here, whereas to maximize your profit on the put, selling the put spread, it could trade back lower. Oops, that's a whole different chart, isn't it? And so instead of making 660 by the price having to move up to this level, if you put that 355 in your pocket, it didn't have to move at all from here. This is recorded, Don, yes. Because profits are limited, is it better to create an iron condor? It depends on how much time you want to spend figuring out what you want to do. Me, I don't want to spend a lot of time analyzing the trade, which is why we have the scans for the best signals and patterns. And then I want to find out or figure out in a matter of minutes what would be my best trade setup. And again, that's what we're going to be doing on the 29th, is going through a full day of analyzing what is the chart signal or pattern, where is the market condition or what is the market conditions, what is our best option strategy for those conditions. So let me see if I can. So here's a bull spread, or here's a bull call spread. I think with this opening positive and this being the next target, we could be buying the May 82s. I think that's where the price was. Yeah, the May 82s at $4.60, or to go to $10. That doesn't make any sense. That's too expensive. But maybe we buy the 82.50, 87.50 for 208. That's just on the fringe. Don't usually like to pay any more than $2. That's getting close enough. Or the 83.50, 87, $1.58 to make $4. I should be able to figure that out. Yes, as long as it's below $1.60. However, the price still has to go up to 87.50 to maximize the profit off of that trade. So here's a case where it has to go up into this range, 87.50, to make this type of profit off your call spread. Your break even would be on the spread 80, or a couple of these. One would be 84.50 The other one would be 85.08, just to break even. But if you sold the 82.78, you put $1.47 in your pocket. Now, what you want to analyze is, what is the probabilities? That's not, obviously, that's not as big a profit as 240 or 290, pretty much double what this is. But that doesn't keep you from saying, all right, the market's heading up, this is heading up. In the next 3 days, it might be trading up here. So instead of buying one of these or 1 unit of these, maybe I buy 2 units because the risk reward is it's going in this direction. Still makes $2.94, knowing that as long as it's going in this direction and not reversing all of a sudden. So you can analyze, well, because this is a much lower risk trade based upon seeing everything open positive and moving in this direction, let's do 2 of these versus 1 of these. Oh, did I do this out of credit spread? Like 300, 52.50, it stays above 290. I think I goofed that up. So anyways, on a credit spread, the price doesn't have to move at all to make the maximum profit out of what you just sold. So if you sold a credit spread and you put $1.60 in your pocket, you probably don't even need to see that price move from that level for the next 3, 4, 5 days. And you're going to keep that $1.60 in your pocket. Whereas to make that same type of profit buying a bullish spread, it might have to move up 2, 3, 4 points to make that same profitability. You're taking the risk factor out. If you know the direction of the price move, you're taking somebody else's enthusiasm or the premiums they're paying for those puts, they're thinking that it's going to go down, and when it doesn't even move, that money stays in your pocket. Basically, the risk reward is a heck of a lot better. It's a much more conservative trading strategy. As long as you know the parameters, what is the general market direction? Well, as we can see, things are heading lower right now. So what do we look for? Well, I hope I didn't do this out of Daku. Looks like it's in wave 3. Still some more downside. So do I want to buy put spreads here or puts? Definitely don't want to buy puts, because look where we are. We're way down here in the oversold area. What was our next prospect? Buying put spreads, mitigating our risk a little bit. Or instead of going out 2 weeks, hoping that it's going to continue down in the oversold area, maybe we go, and what is today? Tuesday. So there's 3 days left to expiration. So we sell a call spread. So the stock was trading, at 44. I can't read my chart. I have to have a magnifier. 44.54. All right. So let's say we look at selling the 45s somewhere in here, and let's say we buy the 47s, which means we put 74 cents in our pocket. What's that tell us about our price move? Well, it would have to come back up into this range versus over the next 3 trading days, that it stays below that level to put that 74 cents in our pocket. What's our break even? I think it would have to stay below 45.74 to break even. Anything below 45, we're going to keep that 74 cents in our pocket. Or what is our risk factor? Maybe that's too close. Stock's at 44.54. Maybe I do a 46, meaning it has to go up from 44.54 over the next 3 days above 46 and sell a 48. Now I'm putting 54 cents in my pocket. Not quite as lucrative, obviously, but it would have to come all the way up here to start losing money. So instead of buying one of these, maybe I buy two of these because the risk factor is a little better. So now I'm putting $1.08 in my pocket. What's my risk? Well, it's going to be a little bit worse if they come all the way up to this level. No, let's see. Yeah, that's right. So instead of my risk, if I bought one unit and put 74 cents in my pocket, what's my maximum loss? $2. The difference between, let's say it closed at 49. I'm going to have to buy these, buy one back and sell the other. So I'm going to have a $2 loss minus the 74 cents I put in my pocket. So my loss is $1. I can figure this out. $1.26. All right. Now a little less risky is if I bought one of these, the price would now have to go up above the 46, the 46.54 to start losing money. But let's say I went ahead and bought 2 units of this and put $1.08 in my pocket, and then all of a sudden it turned around and skyrocketed up to 49. Well, I'd have to buy 2 units of these back, which would be minus $4, or the $4 minus the 108. So my loss is $2.92. So the loss is going to be a little bit bigger, but my risk factor is saying, all right, over the next 3 days, I don't think it's going to reverse and come back up above this level. So this kind of puts us in a situation where credit spreads are very short term, but the magnitude, the percentage of probabilities of making a profit is huge, meaning big time. And that few times that you might lose, if you're protected, like 46.48, and you lost $3.92 off that trade, well, you're probably going to hit 10, 12, even bigger than that, 15, 20 times where your trade is profitable, and maybe once out of every 20 you're going to take a loss, which is not really offsetting the profitability that you're constantly making. So if I'm looking at something like Splunk, what do we anticipate? Wave 1, Wave 2, Wave 3. Well, what's going to happen between now and Friday? Well, I could sell the 72s and buy the 74s and put 52 cents in my pocket. Or, actually, I should have looked and saw where the stock was trading. It's trading at 70.17. So my risk factor is, as long as it stays below 72.52, I'm going to make money off of that trade. So what's my prospect of that? Well, we're already here at 70. 17, anticipating still heading in this direction. Or maybe I want to be a little bit riskier and sell the 71, 74, put 91 cents in my pocket. Again, the risk factor becomes, what do I think the probabilities are over the next 3 trading days that it could pop back up above 71 or 72? So that is why when you look at any option trade, the first thing you want to look at is, what is the math and what is our risk reward? So let's do this. I don't know if I can do this. Let me see if I can do this elegantly. Let's see, are you in here, Magic? Oh, there you are. Okay. So let's start off with one of yours. IBM. What'd you do? The 122, 123, was that it? All right, so don't know. Okay. All right. So if we look at the 122, now that's not a very big premium. Stock closed at 117.80. Let's say basically 118. What makes sense over the next 3 days? Well, let's start right at the 118 level, and we want to sell a vertical. So we're selling the 118s, and we're buying back. I'm going to pick out one. 22. So I can put $1.23 in my pocket. So what's that tell me? Well, it basically says, as long as, whoops, need to put IBM up here. Oh, didn't. Trading at 118. Let's just say hypothetically tomorrow we wake up. How did I get on these charts? That's not the chart I wanted. Let's say we wake up tomorrow and it's opening lower, and we put that spread on. Or maybe tomorrow morning we get it for $1.20. That was the 118. What did I say? 122. All right, what's our risk reward factor? Well, if it stays below 118 plus, let's say 120, so that's 119.20, somewhere right about in here, we're going to make a profit. So that's pretty much the high of today. So if it trades lower over the next 2 or 3 days, that means we've put the $1.20 in our pocket. Now, do we want to do a put spread on here? Well, again, that might be, again, an analysis of the market. I'm thinking, and this is just kind of conjecture. I think the market is oversold. It probably still has a little bit more downside over the next 2 or 3 days. But volatility could spike. Yep. Anything could happen. But what's our analysis right now? Everything's in a downtrend. So if we wake up, I'm going to take a quick look here. Looks like the Dow's right now positive, but let's say when we wake up tomorrow morning and the spread on a 118, 122, selling a call spread puts $1.20 in your pocket. Well, now we know that this needs to continue to trade lower and not come back up again through the 119.20. That was the $1.20 above the 118. So if it stays below that level over the next 3 days, we're going to make a profit. If it stays below 118, which was about right in here, we're going to put that $1.20 in our pocket. So if we saw this opening lower tomorrow, anticipating it was trading lower, where is the stop loss? Jimmy, you decide that based upon, if I don't want to lose any money, I want to out if it comes back up up through that level. Again, we're anticipating that our trend is in this direction. We don't want to see it trading positive. We definitely don't want to see it trading above the 119.20 level. So remember, this is a declining asset. That when you put that $1.20 in your pocket, that meant people were paying premiums for the puts. You sold the premium, meaning somebody bought that put at a premium from you, and then the other one you bought at a much lower price. So that's why even if it stayed flat without moving, those premiums disappear and the $1.20 stays in your pocket. So to come out of the trade still requires analyzing what the chart is doing. Now we use magic again. Today, when he saw the strength in Micron, he closed out his put spread because he saw the price going against him. So just because you put the trade on doesn't mean you can't come out of it. And that's still based upon what direction is everything moving. I'm trying to, now the bigger the, I haven't even looked at these, the bigger the price move or the volatility, but knowing the direction of where things should be going, I might say, all right, I think Amazon, after closing just below that level, if it opens lower tomorrow, stochastic's heading down, I don't know whether I want to buy a put spread, or if I'm buying a put spread, maybe it's for 2 weeks out. But if it trades lower, let's go take a look at the math on the selling a call spread. Whoops. All right, so 3 days from now, stock's trading at 112. So what if we sell the 114s and buy back the 117? All right, that puts 96 cents in your pocket. Is that puts or calls? When you're doing a credit spread, I'll have to go back to that, Kath. Remember, we think the price is going down. If we bought a call spread, which direction do you think, or what do we think the price is going to do? It's going to go up. If we sell a call spread, what's that tell us? We think prices are going down. So on, which one was it? On IBM, if we're thinking that the price is going to go down and we want to do a credit spread, that means we're selling a call spread. That means when we sell one, now let's do it on this one. Let's do the math on this one. That means I am selling the 114s. And the 114s, so let's say I put $1.78 in my pocket. Well, I'm buying back, what did I say, the 117. So put $1.80 in my pocket. Say $1.77, and so I'm putting $1.77 in my pocket, but I'm buying back the 17, so I'm having to shell out 81 cents. So the difference between that was putting $1.80 in my pocket and just to round it off, having to shell out 80 cents. That meant there was $1 difference there. That's my dollar. As long as the price keeps going down, because if the price keeps going down, what happens to the prices of these calls? They're getting lower and lower. And when do they become worthless? Well, if on Friday, darn, I can't remember which one we're doing, on Amazon, if on Friday Amazon is trading below 114, it's already down to 112. But if it's trading below 114, what happens to these prices? They go to zero. So that dollar I put in my pocket stays in my pocket. The short answer is, if yes, you're using Thinkorswim. Just right-click and create an opposite trade. That's what you do. All right, so is that understandable to everybody? I just did Amazon. Again, what were the first analysis is, what do we think? This is the IBM chart. Oh, come on, keep the wrong things. First of all, what's our analysis? We think things are going down. How far are they going down? Don't know, but we know that a very conservative trade is selling calls, because that's the ones that have the premiums in it, and buying back another one up here. So I'm selling. How do I keep getting over on this chart? Who's doing this to me? Let me get it back over here. We think this is still going down based upon our knowledge of a bearish J-hook pattern, breaking this level. So we put the, what I just say, $1.80 from selling the 114s, and we buy back the 117. All right, what's the probabilities over the next 3 days that it could go up here? Probably not as much, with stochastics heading down, with the market heading down, and if it opens lower tomorrow, giving us a bearish doji sandwich below this level. So I put the $1.80 in my pocket. I buy this for safety at 80 cents, so I put $1 in my pocket. And if it trades over the next 3 days below this level, I mean, it's probably still heading down. But as long as it stays below this level, meaning it could pop up a little bit and still by Friday, if it's below this level, we keep that $1 in our pocket. All right, is that understandable? All right. On Friday, you just let everything go, yes, because everything's going to be worthless. So what's the rationale? If the stock on Friday is trading right here, how much are people going to pay for buying a 114? Not going to pay anything, because on Friday, it's not going to close up here. How much are they going to be paying for a 117? Still zero. So the money that you put in your pocket, because there was premiums right now built into those, well, now those premiums have disappeared. The prices have disappeared back to zero. That means you kept the $1 in your pocket. But I'm wondering, if I've been burned on credit spreads, why not use a synthetic stock trade? Buy, put, sell, call. Maribuzo, do whatever you think is best. Again, I don't want to have to sit here and try to figure out the trade. I want to take a look at it. So anytime I look at the trade, I can make a quick calculation. Say, all right, there's still a pretty hefty premium in the 114s. Do I want to get a little bit riskier and maybe go to a 113? Or do I want to get a little bit more conservative and let's say do a, do a 116 and sell a 118. Not very lucrative. It's only going to produce 47 cents. But where I might have bought one of the, what I say, 114, 117s to put 94 cents in my pocket, and my risk reward would have been that as long as it traded below, what was it, 114.94, I was going to break even. But now maybe that I'm putting on, I'm going to clear off some of these. Now I'm selling the 116s. Whoops. Come on. 116 there. And buying back, what did I just say, the 118s? But instead of buying one, or whatever number I'm buying, maybe instead of buying 10, now I can buy 20 with the idea that if we think it's heading down, all right, putting a little more price in it. Would it come back up to here over the next 3 days of trading? Ooh, probably obviously less probability than it could come up through these two. So it might be a little bit more aggressive and buy 20 of those instead of 10. You wouldn't want to sell a call naked. No. Again, the credit spread is a very high probability, low risk, low profit trade, meaning not low profit, but low revenue trade. Whereas if you bought a put and at 6, excuse me, and it dropped down over the next 3 weeks to 100, and that put went from 6 to, I'm going to pick out a number, 22, that's a big deal. However, the probabilities of that happening is much, much less. The spread might mean, all right, put on the spread, what I just say. I bought 20 of these, so I put a 94 cents in my pocket. It closed right here. Now, next week, I do another one somewhere where I'm putting 84 cents in my pocket. That works because of the high probability, low risk. Next week after that, I do another one. So you're putting a lot of small trades on versus waiting for that big price move on anything that you can see. I'll get rid of all these. Anything that you can see is still a high probability trade based upon how much time you have to expiration. Jimmy, yeah, you could do that. But you'd have to figure out, and that's why it would take too long. So you would sell a call, and you would need to buy a long call leg to, yeah. So you'd have to spend some time figuring out what would be your break even, and what would happen if it closed at a certain price. You might be losing money on both of those trades. Magic, usually what will happen is if you've got a spread on and somebody decides to call one side of it, more than likely the brokerage firms can say, hey, it's a spread. He's got it protected. They'll go to another spot. But the worst case scenario would be if they called your side that was unprofitable. Worst case would be that you would say, all right, exercise the other side, and you're exercising that to offset so that you can get the person the stock. Oh. Okay. All right, Jimmy. I didn't read. All right. So the difference between buying a debit spread is you're putting out money and you're hoping the price of that price moves in the direction that you expect. It doesn't have to move as much as if you bought calls outright or puts outright. A credit spread has a lot more advantages. Again, not the profitability might not be as great, but the percentage of profitability or times that you're going to profit is going to be huge. So it's more of a constant income strategy versus trying to hit a big price move. All right. I'm hoping I did that clearly. It's usually a difficult process to figure out, all right, if I think things are going down, I want to sell calls. If I think things are going up, I want to sell a put spread. And the difference is the price of whatever I'm trading now has to be evaluated as to where are we in the overall market trend and where are we in that price trend and where do we think it's going to move on a short-term basis, meaning X number of days. All right, about all we got tonight. Again, on the reason I'm kind of doing these in bits and pieces so people have kind of a little bit of, I want to say, mental assessment, because on the 29th, we're going to take the whole process of when do you buy calls or puts, when do you buy debit spreads, call spreads, put spreads, and when do you want to be buying credit spreads, and or when do you do a combination of both? All right, so with that, we'll see everybody bright and early in the chat rooms tomorrow.